total income and the tax payable. So income tax is levied on assessee's total income. The total income has to be computed as per provisions contained in the IT Act. Let us go step by step to understand the procedure of computation of income for the purpose of levy of Income Tax Act. So first you have to find out the total income, then apply the income tax rate and find out the tax payable. So income tax is levied on assessee's total income. The total income has to be computed as per the provisions of the Income Tax Act 1961. So what is the first step? Determination of residential status. So residential status is one of the important thing to be found out before going to the next step. So the residential status of a person has to be determined to determine which income is to be included in to ascertain which income is to be included in computing the total income. So the residential status is as per the income tax is shown below. So residential status as per the income tax. First is a resident and non-resident. So there are two broad categories. First category is called resident and the second category is non-resident. Resident and ordinarily resident and resident but not ordinarily resident. So why is it very important to find out the residential status? Because the total income is to be calculated after determining the residential status only. For example, there are certain income which are to be included for a non-resident, which are to be not included for a common resident. So the status, depending upon the residential status, the application of rules, some of the rules also varies. Therefore, residential status of a person has to be determined to ascertain which income is to be included in the in computing the total income. So what are the broad categories? First is the resident and the non-resident. Resident is one category, second category is non-resident. So the first is the resident. Resident and ordinarily resident, resident but not ordinarily resident. Two broad categories. Resident and ordinarily resident, resident but not ordinarily resident. What is the step 2? Classification of income under different heads. So income is of various heads. So the Act prescribes 5 heads of income. These are all shown as below. So what happens? Even after to find out the income, first step is to ascertain the heads of income and find out the income deriving from each of these 5 heads. So there are broadly 5 heads and we have to find out what is the income coming from each of the 5 heads and find out the total income and in the next step. So heads of income. What is the heads of income? First, salaries, pension, everything will come under the broad head salaries. So salaried people, their income will be computed under the head salaries. Income from house property. For example, if a person is receiving rental income, then that is the income from house property, and he's taken some loan for that property, so that has to be deducted. So all these will come under income from house property. Income means the net income from the house property. Profits and gains of business or profession. So a person is running a business. What are the profits and gains arising out of that? He is running a profession. What are the profits and gains arising out of that? Next is called capital gain. A capital gain that is arising out of the sale of land or sale of shares, etc. Income from other sources. So this is the residuary head. So there are some income which cannot be fit into all the other 4 heads. Therefore, they will automatically come in the 5th head, that is a residuary head, income from other sources. So the Act prescribes 5 heads of income. These are below: salaries, income from house property, profit and gains of business or profession, capital gains, and income from other sources. So heads of income: salaries, income from house property, profit and gains of business or profession, capital gains, income from other sources. So income from other sources is called IFOS in short. So CG is for capital gains. So PGBP. So all these are all abbreviations for the various heads. Next is exclusion of income not chargeable to tax. So first step is to find out the residential status. Next is classification of income under the various heads. Next is exclusion of income not chargeable to tax. The government is very particular about some income, exempt income. So the government cannot blindly tax all income. Why is that so? In considering the welfare of the country, in considering the whole status of the country, there are certain income which should not be taxable under income tax. There are certain income which are wholly exempt from income tax, for example, agricultural income. Why is that so? The government is for the welfare of the farmers. Therefore, already farmers have huge debt and also they have struggles in bringing up their crops and also selling their crops. And therefore, the government has felt that agricultural income should not be subject to income tax. Therefore, it is exempt from income tax. These income have to be excluded and will not form part of gross total income. So gross total income has to be found out. While doing so, we'll exclude this kind of income which is wholly exempt from income tax. Example is agricultural income. So there will be a special welfare reason for the government to exclude such type of income. Next, also some incomes are partially exempt from income. So government, there are some income which government do not want to tax it fully. The government may tax it partially. The government may exempt some income fully. The government may exempt some income partially. So two types of exemption, full exemption or partial exemption. So some incomes are partially income from income tax act. Example, house rent allowance, education allowance, etc. These incomes are excluded only to the extent of the limits specified in the Act. The balance income over and above the prescribed exemption limit would enter computation of total income and have to be classified under relevant head of income. So what happens? There are two types of exemption. So one is the complete exemption, full exemption. So the income should be fully exempt from Income Tax Act. Next is the partial exemption. So what is the meaning of partial exemption? The income is partially exempt from Income Tax Act. So income which is fully exempt from Income Tax Act, income which is partially exempt from Income Tax Act. So these are the two broad heads. These incomes are excluded only to the extent of the limit specified in that. The balance income over and above the prescribed exemption would be classified under the relevant head of income. So for with regard to complete exemption, no problem. Partial exemption, what happens? Whatever amount which is chargeable to tax only will be chargeable and the rest will be exempt. Next, computation of income under each head. So we know that there are a lot of exemptions under each of the head given, and also there are various specified computations to be known. So for each of the head, for example, under salary head, under profit and gains of business or profession, under each of this head we have to find out the total income. For example, the person may be involved in 2 or more business. If that be the case, we have to find out for the broad heading of profit and gains of business or profession, the income from both the businesses have to be added to arrive the income from each head. So there may be some specified deduction for all these businesses, etc. We have to do the deduction. There are 2 or more professions. We have to add the income of both in order to find out the total income from profits and gains of business or profession. So we have to, the first step is to the computation of income under each head. For that, income is to be computed in accordance with the provisions governing a particular head of income. Under each head of income, there is a charging section which defines the scope of income chargeable under that head. And what is the next step? There are also certain deductions and allowance are prescribed under each head of income. So charging section is very common section. So charging section defines how each of this head, for example, salaries or profit and gains of business or profession or capital gains, each of these have a specified charging section in accordance to which the income is being charged. And also there are some specified deductions for each of this specified income. The government has given specified deductions. So specified allowances are given, specified calculations are given. So while finding out the total income from each of this head, you have to apply all these rules. You have to apply the deductions, allowances, and arrive at the final income for each of the head of income. Next, clubbing of income of a spouse, minor, child, etc. For example, in case of individuals, income tax is levied on a slab system on the total income. So we know that income tax final taxation is based on slabs. There is a specified slab, basic limit up to which the income is exempt. Above that, it is coming on slab basis. So the tax system is progressive in nature. That is, as the income increases, applicable rate of tax increases. Why is that? So the income tax is called progressive taxation. What is the meaning of progressive taxation? It means as and when the income is increasing, the tax is also increasing. As and when the income is decreasing, the tax is also decreasing. What is the meaning? The government want to tax more amount from the rich people. The government want to tax less from the middle class and the lower middle class people. That is why income tax system is progressive in nature. More taxes from more income people, less taxes from less income people. So income tax is levied on a slab system on the total income. Some taxpayers in the high income bracket have a tendency to divert some portion of their income to spouse, minor child, etc. Let us take a case where a person has got a huge income in profits and gains of business or profession. What does he do? His wife does not have an income. Then what do you do? He tries to channelize some of his income to his wife's name, and he files a return in the name of his wife for that specific amount. So what happens? He is thereby transferring the income to his wife, even though the wife is nowhere related to that income, and thereby the individual is trying to reduce his what income tax output payable amount. So what happens? The the income is being diverted to spouse in order to reduce the taxation. So what happens? To minimize the tax burden, the income is diverted to spouse, minor child, etc. In order to prevent such tax avoidance, clubbing provisions have been incorporated in the Act. So what happens? The government finds out whether that income is pertaining to that particular person or not. If it is not for that person, if it belongs to someone else, and if it is just channelized in order to avoid the tax, the person whosoever is channelizing has to pay the tax, and he cannot avoid the tax with regard to channelizing. So by channelizing, diverting the income to the spouse or minor child, a person should not avoid the tax and reduce his tax liability. If that be the case, the amount which is diverted is added back to the individual itself. That is why clubbing provisions have been incorporated into that, under which income arising to certain persons have to be included in the income of the person who has diverted his income for the purpose of computing tax liability. Next, set-off of carry forward and set-off of losses. For example, the government has provided that when a person is, there are two situations. Under one particular head, he is getting income or gain. Under another head, he is incurring a loss. Can it be set off? So that is one kind. Within the different heads, whether set-off is possible or not. Second condition, a second kind of set-off is, he might have incurred a loss in 1 year, but he might have incurred a profit in another year. That is also has to be set off. So set off can be within the various sets, or set off can happen from year to year. These are all types of set offs. So set off or carry forward and set off of losses. An assessee may have different source of income from under the same head of income. He might have a profit from one source and loss from the other. There are provisions in the Act for allowing inter-head adjustment in certain cases. Further, losses which cannot be set off in the current year due to inadequacy of eligible profits can be carried forward for set off in the subsequent year as per the provisions contained in the Act. For example, let us take profits and gains of business or profession. He is doing more than 2 or 3 business. In one he is incurring loss, other 2 he is incurring gain. So can it be set off? We have to find out. He is gaining from capital gains, but in profits and gains from business and profession, he has got losses. Can it be set off? That is also to be taken care. Now, he has got a profit in 1 year. In the next year, he has got loss. What to be done in such a case? Whether it can be set off or not. That is also to be taken care. So, set off or carry forward and set off of the losses deal with all these cases within the same head, under 2 subheadings, whether it could be set off or not. Under 2 different head, whether it could be set off or not. From 1 year to the next year, whether it could be set off or not. Next, computation of gross total income. The next step is called computation of gross total income, computation of GTI. What is that? Final figures of income or loss under each head of income. After allowing the deductions, allowances, adjustments are then aggregated after giving to the effect to the provisions for clubbing of income, set off and carry forward of losses to arrive at the gross total income. So we have seen deductions, we have seen set off, we have seen various clubbing of income. All these are all deductions, allowances, everything is adjusted, and finally we are arriving at the step called gross total income. Now from the gross total income, what is the next step? Deductions from gross total income. So we have deduction in respect of payment, deduction in respect of certain income, and other deductions. So what happens? You are making some LIC payment, or you have got some, by virtue of a particular income, you are getting a natural deduction by the government. You are paying some LIC, or you are doing some payment, because of that you are enjoying enjoying some deductions. Because you are getting income from a particular source, you are enjoyed for a blanket exemption. So that is another type of deduction. So we have different types of deductions. So from the gross total income, deductions is the next. Next is total income. Gross total income minus deductions gives total income. Income arrived at after claiming the above deductions from the gross total income is known as the total income. So GTI minus deductions will give you the total income, which should be rounded off to the nearest multiple of 10. This is very important. Always the total income to be rounded off to the nearest 10. What will be the next step? Apply the rate of tax. We know that rate of tax is slab wise. So apply the specified slab for the specified income and find out the total tax. Surcharge or rebate under section 87A. Next is tax payable or refundable. So if there is surcharge or if there is a rebate under the act, apply that. If then we will we will know what is the total tax payable, and we will also if there is some TDS and stuff like that, we can also know whether the tax is refundable from the government or not.